Okay, I want to welcome everyone. Thanks for joining us here in Midtown at our off-site convening away from Columbia University uptown. Pleasure to welcome you all here to Midtown Manhattan for a conversation about what's happening in the energy world today with the BP Statistical Review, hot off the press, released yesterday in London. Spencer Dale is straight off a plane from the UK to share the insights from the Statistical Review with us here in New York, and it's really a pleasure to welcome Spencer back to the Center on Global Energy Policy at Columbia. My name is Jason Bordoff. I'm a professor at Columbia School of International Public Affairs. I direct the Center on Global Energy Policy. We've been lucky enough to host Spencer a few times now to talk both about the Statistical Review and the Outlook, and it's great to have him back with us in New York. I think this is an incredibly timely moment to have this conversation, given how dramatically, I feel like I say this every year, but every year it's more true than the year before, how much things seem to be in flux, how many moving parts there are, how much the energy world seems to be turned on its head, from extraordinarily rapid growth rates of coal in China, and as Spencer will talk about, we may have seen that peak and start to decline. Every day a different story seems to lead one to believe that either India is doubling down on coal or getting off of coal, and trying to understand what the outlook there really is. Just the oil market report from the IEA this morning, which talked about the extraordinary impact that this new short cycle dynamic of U.S. shale is having on global oil markets, OPEC's ability to control the market, continued growth in global oil demand at the same time that everyone's talking about peak oil demand, and we're getting off of oil maybe sooner than people think. Of course, we've had the U.S. pull out of the Paris Agreement, and we're going to see likely a sharp change in U.S. policy toward energy and climate. So I could go on and on. The global gas market is changing. We're having U.S. exports all around the world now that are causing a lot more competitive dynamics in the gas market and much else. So a lot of moving parts, a lot of uncertainty. It makes the work that Spencer and his team do to understand what has happened recently and where we're headed all the more challenging, but also all the more timely for Spencer to join us today and present the Statistical Review. So what we're going to do is have Spencer come up. He's, as many of you know, the Chief Economist of BP, and previously took that position, I think, in 2014, and previously was the Chief Economist at the Bank of England, a member of the Monetary Policy Committee there. And he's going to present for around 25 or 30 minutes the Statistical Review, and then join us on a panel discussion. And I'm going to ask Antoine Halff and Amy Jaffe to join us for a little bit of a conversation and reaction, and then we'll take questions from the audience. I will remind, we have many people watching online, as we always do. So I want to remind those of you watching online as well, you can also ask questions of our panelists using the hashtag CGEP events on Twitter and the Twitter handle at Columbia U Energy. For those of you who are here, just please silence your cell phones, and then we'll have a microphone in the middle of the room when we turn to questions from the audience after a little bit of a Q&A that I'll engage in with Spencer and Antoine and Amy. So thanks to all of you for coming, and please join me in welcoming Spencer Dale.
Thank you very much, Jason, and thank you everyone for sparing the time to come today. It's a real honour to, it's the third or fourth time I've presented at the Centre on Global Energy Policy. The Centre on Global Energy Policy under Jason's stewardship is really establishing itself as around the world as being one of the most important think tanks, thinking about global energy policy, bringing together academia, policy and industry in terms of trying to think through energy issues. So you're very lucky to have it in your own city, and so it's a real pleasure to be here. As Jason said, we published the BP Statistical Review of World Energy yesterday in London. In some sense, the launch is really easy, because the point of the launch is saying, guess what? The new data are available. The Excel spreadsheets are now updated. Go, and they're all available to you free of charge. BP.com. Go down, download your data, and off you go. And so, in that sense, my job is done. Because people say, well, that's rather dull talk, Spencer, can you talk a bit more? We also then try and tease out some of the issues and features of what happened last year. Because we've got a panel discussion today, I'm not going to try and cover everything. I'm going to sort of focus on a couple of issues. I may not be able to bring it out today, but one of the big themes in energy markets, and if you're interested, there's a sort of a longer piece in the front of the document, the the booklet talking about this is energy markets last year were being affected by two forces. There was lots of short-run adjustments going on. Essentially, there was excess supplies in oil markets, in gas markets, and coal markets, and so you sort of a lot of adjustment as markets were adjusting to those short-run supplies. In addition, you had this sort of growing gravitational pull from the longer-run energy transition, which were affecting energy markets. And what we saw last year was a sort of a confluence of those two forces coming together. And so one of the sort of interesting features of trying to think through last year is how much of this was a cyclical story and how much of this was part of the longer-run transition, and how should we think about those two things. And I'll try and bring out a little bit of that. But that's sort of the big sort of way of thinking about it for me for last year. And given the panel I've got the privilege of sitting with, I thought I'm going to focus on two issues today. So one is on just what sort of the really quite profound and striking developments we've been seeing in carbon emissions from energy over the last couple of years, and ask the question, pretty much the question here is this a short-run cyclical thing, or is this part of a longer-run transition? And then I also thought I would focus on oil markets in 2016 and some of the behaviours we've seen in oil markets, and trying to understand what that's telling us. So starting first with some of the headlines and moving into carbon emissions. Global energy demand grew by just 1% last year. That's the purple bars. 1% is a low number. The average growth rate over the last 10 years is closer to about 1.8, 1.9%. So this is a weak growth number. Some of that you can relate to sort of the weakness of GDP last year. It's particularly weak. Global GDP was particularly weak. But this is continued trend. This is the third consecutive year in which we've seen global growth in energy of 1% or less. And it's gone hand in hand with increasing falls in energy intensity. So the amount of energy needed to produce each unit of GDP, those green bars, which are also falling at historical rapid rates. And so we're moving to a world of slower energy growth, the counterpart to that, using energy more efficiently. In terms of the pattern of growth, as is the new normal here now, almost all the growth in energy demand came from the developing world. If you look at the OECD here, that's a green bar, it's essentially nothing. All of the growth in energy is coming from developing world, with here China and India accounting for almost equal increments of energy demand growth last year. That's the two blue-coloured bars. The thing to note here, though, although they have pretty similar increments this year, compared to how that compares to the past, it's very different. India's energy increment pretty similar to previous years, where China's a sharp slowing in 2016 relative to the average growth seen over the last 10 years. So China's energy demand growth slowing very sharply. And I'll come back to think about what's going on in China and how to think about that in a moment. So all the growth in energy demand coming to the developing world, China and India together, almost half of that. In terms of the fuel mix, I mean, perhaps 2 points. One is, if you look at the chart on the left, it just makes this point about short-run adjustments I was just talking to you about. For oil, coal, and gas, the consumption of all of those fuels all increased more significantly than the production of them, if you compare the left-hand bar with the right-hand bar. And this is symptomatic of the excess supplies we saw in all three of those markets, and those markets adjusting to that. The other big picture about the fuel mix is a sort of a continuing shift in the fuel mix. So if you like, in terms of that energy transition story I tell you about, you can really see that here in the fuel mix. The fastest growing energy source was renewable energy, shown here in orange. So when BP thinks about renewable energy, we separate out hydropower because it's sort of growing at a different rate. So here, renewable energy is dominated by wind, solar, and to a lesser extent, biofuels. That only accounts for around 4% of primary energy, but its growth rate meant that it accounted for almost a third of the increase in primary energy. So tiny share, but accounted for almost a third of the increase in primary energy. So fast growth in renewable energy. On the other side, very sharp falls in coal, shown here in grey. This is the second consecutive year in which we've seen significant falls in both the consumption and the production of coal. The fall in global coal production last year was the largest we've ever seen in terms of our records. And the change in the pace in the deterioration of coal and the fortunes of coal has been really quite stark. Only 4 years ago, coal was providing was the most important fuel in terms of its contribution to growth, where now we've seen very significant falls in coal production and consumption over the last few years. And the scale of those falls feels to me like we've seen a decisive break from the past in terms of the fortunes of coal. So the combination of slower growth in energy, together with this shift in the fuel mix away from coal towards renewable energy, then had this property, I didn't expect that chart, that one, this property that carbon emissions, shown here in the purple line, were essentially flat last year. So carbon emissions from energy use, we estimate were essentially flat last year. That's the third consecutive year in which we've had essentially flat or falling global carbon emissions. If you look at what's driving that fall in carbon emissions, a little bit is because GDP growth is slowing. That's the orange bar. But the big driver here is the carbon intensity of GDP is declining more rapidly. Now, the carbon intensity of GDP is, for every unit of GDP I produce, how much carbon am I emitting? And that's falling for two reasons. One, does this work? Yeah. Energy intensity is declining. So for every unit of GDP I produce, I need less energy. And also because the fuel mix is improving. For every unit of energy I use, I'm using cleaner, lower carbon fuel. I'm using more renewable energy, less coal. And those two things together causing this fall in carbon emissions. Now, how to think about this? If I look, so over the last 3 years, carbon emissions flat to falling. If I look at the previous 10 years before that, they were growing at an average growth rate of 2.5% a year. So when we're thinking about Paris and the challenges of Paris, an absolute key question this raises is, how do I think about the last 3 years? Is this a decisive break from the past? Is this part of the long-run transition? Have we really gone from positive growth rates to flat? Now, to get to Paris, we would need to see quite significant negative growth rates, but at least you'd be taking a step there. Or is this largely cyclical and it's going to bounce back? Which one is it? How do we think about this? Well, as a first way into this question, well, what's driving it? Just in terms of the arithmetic, what's driving it? Which is what this next chart is designed to do. So the way to read this next chart is, this is the average growth rate of carbon emissions, nearly 2.5%, as I said, in the period 23 to 2013. And this is the average growth rate, essentially flat over the last 3 years. Just arithmetically, what's driving that? It's China. So just in terms of the arithmetic, the big driver of this is what's going on is China. And so the question is what's going on in China and how do I think about this? So some of what's going on in China is a structural story, and it reflects the shift and the changing pattern of demand in China towards essentially a more sustainable pattern of growth. So there's three things which are underpinning this in a structural sense in China. One is slower economic growth. So rather than growing at growth rates of double-digit growth rates of 10% or more, economic growth is now somewhere growing between 6 and 7%, so slower economic growth. Secondly, what's really important is the pattern of that economic growth is shifting away from the industrial sector, which is very highly energy intensive, towards more consumer service-facing growth, which is a lot less energy intensive. You need a lot less energy to give somebody a haircut than you do to build a big widget. And the third component here is a very significant shift in the fuel mix in China away from coal towards cleaner, lower carbon fuels. China last year produced more renewable energy than the whole of the OECD put together. So those three things are structural and they're likely to persist. So that's a good news story. But there's also some very significant cyclical things going on in China at the moment. In particular, we saw a sharp slowing over the last few years in some of China's most energy-intensive sectors. So if you look at iron, steel, and cement, these sectors, through much of the 2000s, were growing at well over 10% a year. And essentially, they were growing at well over 10% a year because they were fueling China's industrialization. This is where it's focused. What we've seen in the last 3 years is they've fallen in outright terms. The reasons why this matters is around a quarter of China's energy consumption is made up of by these three sectors. And so if I look at China's energy consumption, the growth of energy consumption, there's slowing in China's energy consumption from well over 6% a year to this number around 1%, you can see a very significant proportion of that slowing in China's energy consumption relates just to those three sectors. And it seems to me pretty unlikely that we're going to carry on seeing falls in these sectors like we've seen in the past. And even if they were flat from now on and never had any recovery, if they were just flat, this negative contribution would go away and the growth rate would go up. And so when we're thinking about China, it seems to me some of it, and so again, we're thinking about China, but therefore we're thinking about global carbon emissions. How much of that is real, structural, how much is cyclical? It feels to me there's good reasons for thinking some of that is structural, underpinning those changes we're seeing in China, slower growth, shift in the composition of growth, cleaner fuel mix. But some of it to me looks like it's cyclical just by the scale of the slowdown in these three sectors and and the importance that has in overall energy demand. It's also worth saying not only are they very important in terms of energy consumption, they also are very coal intensive as well. So you get, as they come back, not only will it increase energy demand, it will also shift the fuel mix as well. So that's one issue. There's carbon emissions going on. How do we think about that? How structural, how cyclical is it? And in some sense, this is why something like the SATS view is so much fun, because it allows you to just look at these data in the round and see what's going on. The second thing I wanted to talk about is oil. You've got to talk about oil, surely. So trying to think about the oil market. And I think the key point here is 2016 was a year of adjustment for the oil market. And you can see that on both sides. So in terms of demand, which is shown on the left-hand side here, we saw another year of very strong demand growth in 2016. Oil demand grew by around 1.6 million barrels a day. As you can tell from the colours there, nearly all of that growth in oil demand was coming from oil importers. So oil importers benefiting from low oil prices, boosting oil demand. This is just simple price adjustment mechanisms. On the supply side, that low prices also led to a slowing in production, particularly in non-OPEC supply. In the green bar here, that non-OPEC supply fell by around 0.8 million barrels a day last year. That's the biggest decline we've seen for almost 25 years. A big driver of that was US tight oil. So US tight oil, from growing strongly in 2015, fell in outright terms in 2016, and that swing there's a swing of around 1 million barrels a day in terms of US tight oil, and that accounts for a big chunk of this slowing. OPEC production continued to increase. The yellow bar here, essentially Iran, Iraq, and Saudi Arabia together accounts for all of that increase. But the net of this, but even so, net aggregate supply growth of supply was pretty weak. That stronger growth in demand was sufficient to bring the market back into balance last year. So we'd had this persistent gap between supply and demand through 2014 and 2015. By the middle of last year, that gap was largely absorbed and brought back into balance, reflecting this strong demand growth and weak supply. But that was not before stock levels had risen even further. And so the big question this raises, and the big focus of oil markets now, is how quickly will stocks unwind, and how should we think about the pace at which stocks unwind. When thinking about oil markets over the last few years, and also when thinking about oil markets going forward, there are two sort of players which are dominating how markets are performing: US tight oil and OPEC. And so we used sort of the opportunity of the statistical review to sort of look and see what we can learn about the behaviour of those two players, the OPEC and US tight oil. If we start first with US tight oil, I mean, I think the key message from US tight oil is the short cycle nature of tight oil means it did respond to price signals far more quickly than conventional oil. So this chart here just shows the number of rigs operating in US tight oil. And you can see that within 5 or 6 months of prices starting to fall, rigs started to come off. Likewise, as prices hit their trough and started to rise at the beginning of last year, only 3 or 4 months before prices started to come back on. And that rig activity, the decline in rig activity, and then the subsequent rise, then fed through into output growth, with slowing output growth in 2015 and 2016, and a picking up of output growth more recently. So how do we think about tight oil? What's interesting, as we've gone through this, some commentators have talked about the surprising resilience of tight oil. But I think it's really important that we've got to be clear about what we mean by resilience. These data and the output data underpinning them, I think, make clear that tight oil did respond more quickly to prices than conventional oil, and in doing so has acted to dampen price volatility. So it acted to dampen price volatility on the way down because supply came off and so prices had to fall less. And it's clearly dampening price volatility on the way up at the moment because that increase in shale is acting to limit the extent to which prices rise. So in that sense, the tight oil did perform like it was supposed to perform. I think the resilience of tight oil is better described in terms of a toy I used to have when I was growing up. And a toy is, I'm not sure if you call them, so in the UK they were called Weebles. So I'm not sure if you had Weebles in the UK. And the key thing about a Weeble was Weebles wobble, but they don't fall down. This is our 3D Weebles, okay? So the point here, this is sort of funny, but this is an important point. The short cycle nature of tight oil means it falls back, as prices fall, it falls back more quickly than other types of oil. But tight oil is not the marginal barrel of oil in the long run. Other types of oil have higher all-in costs than tight oil. So as the market adjusts and prices respond, tight oil springs back, exactly as a Weeble, exactly as we are seeing now. And I think that's the way to think about the resilience of tight oil. It may well fall back, but then it will spring back again as well, just like the Weeble. The other question is, how do we think about OPEC? And OPEC behavior has been surprising, and it's sort of surprised markets in two ways. First of all, OPEC surprised people in November 2014 by not cutting oil and surprising people and causing a price collapse. And then OPEC seemed to change course in November of last year, and then started to and agreed together with 10 non-OPEC members to a cut in production, which it recently extended into the beginning of next year. So how do we make sense of OPEC? Why did they first of all not cut, and now do they cut? Are they changing their mind? How should we think about this? So my argument was no. There's no inconsistency here. There's no change of strategy here. You just have to think about the type of shocks in which OPEC are responding to. And I think the best, I don't like doing quotes, but I think the best way of explaining this is a quote by Khalid Al-Falih, who's a Minister of Energy, Industry and Mineral Resources for Saudi Arabia. So essentially the man in charge of OPEC to a very large extent. And he gave this quote earlier this year. And I'll just read it out and then I'll just sort of say how I think about it. So OPEC remains an important catalyst to the stability and sustainability of the market. But history has always demonstrated that intervention in response to structural shifts is largely ineffective. That's why Saudi Arabia does not support OPEC intervening to alleviate the impacts of long-term structural imbalances, as opposed to addressing short-term aberrations. Now, I used to be a central banker, so I like words like this. But if we unpack this a little bit, just to see what this actually means, the power of OPEC stems from its ability to shift supply from one period to another. So in response to temporary shocks, it has lots of power. Suppose something caused demand to be weak for a period or supply to be strong for a period. It can adjust its own supply to offset that shock, wait for that shock to subside, and then bring back its supply back onto its normal level. And so in response to temporary shocks, it has lots of ability to smooth through shocks. But you think about a persistent shock. If I take off supply one period and then put it back to another period, that has very little impact at all if the shock is just carrying on persisting. And that's exactly what this is saying. Now think about 2014. What caused the supply imbalance in 2014? It was the emergence of US tight oil. That was a structural shock. Remember the Weeble. This was an intramarginal source of supply. It wasn't going away. It was going to bounce back again, just like the Weeble. And so in response to that structural imbalance, it seems to me it makes perfect sense for OPEC not to respond to that, because shifting supply from one period to another, as we know, has very little impact on persistent shocks. So what about the most recent cut? Well, the most recent cut is designed to increase the pace at which oil stocks will come back to more normal levels. That's exactly the type of short-term aberration in which OPEC action can work. So I take my supply off while stocks are run down, providing an alternative source of supply in the market. As supply of those stocks get back to normal levels, I can bring my supply back on. So exactly as you would expect an OPEC intervention to work. So my argument would be there was no surprise in what, oh, well, there clearly was a surprise, but there was no sort of inconsistency. And at least in hindsight, I think the quote from Minister Al-Fali explains entirely why OPEC behaved as they did. In 2014, they didn't respond because it was a structural shock. In 2016, they're responding to this short-term aberration of how quickly stocks come back down to more normal levels. There's tons more information in the energy outlook. There's some fascinating stories about natural gas markets. There's some fascinating stories about the power market. Some of that, all the data are there. Some of the analysis is in the front of the book. If I really whetted your appetite, you can go. I did a long presentation on this yesterday. You can either read it or you can even watch it if you like on bp.com. But let me stop now and we'll hand over to the panel. Thank you.
Thank you, Spencer. That was great. A really fascinating overview. Obviously, there are many more issues we could go into, and people should look at the statistical review and the slides and the speech that you gave yesterday in London. So I have questions, but first I just want to kind of open it up to a couple of general reactions from Antoine and Amy. So I think, and both of whom are hopefully known to most of you. Antoine, who's a senior research scholar at the Center on Global Energy Policy and leads all of our work on global oil markets, was the former chief oil analyst at the International Energy Agency in Paris, responsible for the oil market report, like the one that came out this morning, the medium-term oil market outlook, and previously was at the IEA and worked in many other positions in public and private sector over a long career in energy markets. And Amy Jaffe is also well known to all of you, a leading expert on all things in global energy and sustainability and geopolitical risk, global fellow at the Woodrow Wilson International Center for Scholars, and now at the University of California, Davis, as the Executive Director for Energy and Sustainability there. So thanks to both of you for joining us in New York today. I have several specific questions that I'll come to in a minute, but let me just kind of open it up to you to kind of give a general reaction to what Spencer said and what sort of struck you as most interesting, and pick the kind of piece of it that you want to comment on and give a little bit of reaction to. Amy, let me start with you.
Well, I think it's very, very interesting to look at how robust the drop in energy intensity is, and then to think about the implications for that for global carbon emissions. So I think it's interesting to explore this question of structural versus cyclical, especially on the Chinese side. So, and that really comes down to sort of a fundamental view of where people think the Chinese economy is going. I mean, if you really believe that the Chinese economy is going to move towards services, then one might imagine that the cement and steel industries, given the fact that China has, in China proper, has put in a lot of overcapacity at this point in real estate and other kinds of facilities, that might not repeat itself again. And that would mean that it was more structural than cyclical, right? And then if you also looked at China's commitment to advanced technologies in the energy space, the standard argument for the fact that the Chinese oil demand will rebound is sort of a consumerist argument, right? Chinese are using internet purchasing of groceries and consumer goods, and that's all going to be delivered by truck, and that those trucks are all going to use oil-based fuel. That's sort of the argument, and that as people become wealthier in China, they're all going to have a personal automobile. And the question is, is that really going to be the case? The other question is going to be, how successful do people think the One Belt, One Road policy is going to be? How much construction? Would China succeed in exporting all its overcapacity in steel and cement into these other markets? And would it be comparable to what we saw over the last decade or so? And that would be sort of the argument for why it's cyclical, but I think that's something we can all explore.
So I just wanted to follow up on that. I want to make sure I understood, Spencer, what you were saying. I mean, the first few slides you showed, I thought, were incredibly interesting. You made a comment about sort of historically high level of decline in energy intensity. I wasn't sure I saw that. In terms of energy intensity, seems to have been declining for a long time. What was new was when you came back and said, CO2 intensity is now falling even faster than energy intensity, and it's not just about energy efficiency or using our energy per unit of GDP better. It's about a switch in where the energy comes from, and that's what's new.
Yeah, I think, just to say, on that 5-year average, perhaps we're splitting hairs, the 5-year average in that dotted line in the first chart for energy intensity, that dotted green line is at unusually low levels. And technically, it's never been as low as this. There was it got close to it in 2000. So it is, but it's not unbelievably so. So I think it's two things going on. It's strong falls in energy intensity, and then that's overlaid and compounded by this shift in the fuel mix. And remember, in the previous 10 years, coal was the fastest growing source of energy. And it was the fastest growing source of energy because it was fueling China's industrialization. Right. It is now sort of falling very sharply. And that shift in the fuel mix is sort of adding to the impact of lower energy intensity, sort of give us this really good news story in terms of carbon emissions.
Right, and that's what so that was the story of energy intensity falling, and then the fact that these blue bars are now getting bigger sort of talks about, that's the idea behind the transition. Maybe we're actually starting to transition to a different fuel mix.
And that's the point here is, when your eye looks at this chart, you think, well, green's a lot bigger than blue. But if you think, well, what I'm trying to do is, what's different about the past? Right. What's different about the past is those blue bars have got significantly bigger relative to the past, relative to the green ones, which is your point, Jason. So it's not only have I got fairly chunky falls in energy intensity, I've now got the fuel mix really improving, moving to a cleaner, lower carbon fuel mix, and those two things are compounding each other.
And then the question of whether one expects those blue bars to continue to grow, that's the transition. And then I just want to make sure I understood your thinking about this, how it connects to this slide, because you made the point that we've seen this structural change in China, but that can only go so far. Yeah. That's not going to replicate itself every year. What does that mean for the fuel switch?
Yeah, so I think this is about energy, not about the fuel switch. If I had better data, I'd be able to do it on both. It's just some of the industrial data in China on consumption. The point here is, economists love derivatives and second derivatives, right? That's what economists do. So what happens here is you've got this sharp fall in the growth rate of outputs of these three sectors, iron, steel, and cement, to these outright falls, which has given you this big drag on energy growth, shown here by this this bit here. My point here is, suppose none of that rebounds, and suppose you get no growth in any of these three sectors forevermore, which I'd find pretty surprising, because if the economy they're going to have to keep on growing, they will have to industrialize other parts of China over the next 20 years. But let's just suppose it doesn't grow anymore. This negative contribution goes to zero. and therefore energy demand growth will rise. You only get this growth rate if you get a bigger fall again. So instead of just going these negative numbers, you would need them falling by 8 or 10%.
So that means, would the takeaway from what you're saying be, you would expect that the annual change, the increase in energy demand growth that comes from China going forward would look more like the top of that purple bar, not the black total.
Yes, which is sort of halfway between where we are today, if you like, in very crude numbers, and where we were. So a big chunk of it structural, but some of it cyclical.
Right. Okay. So I want to come back to some of that. But Antoine, let me bring you in to give some general reactions, and then I want to ask you particularly about the next part on kind of the oil demand outlook.
General reaction is it's always a treat to listen to Spencer, because the statistical review, it's kind of a dry exercise in a way. It's looking at last year's data, it's old data, and we haven't even forgotten them because it's so recent. So it looks like there's no surprise, but it's always interesting and surprising to listen to you, because you extract, great analysis, and you kind of tease out forward-looking elements out of the recent history. Clearly the granularity that you bring on China, I think, is very interesting. We tend to, China is one of the most important drivers of the market. It's been the 50% of global oil demand in the last 15 years or so. But we tend to look at it with a very lack of granularity, a very rough way. Looking at it by sector, trying to segregate, what comes from the industrial sector and other sectors is, I think, provides a lot of insights. I'm curious what kind of confidence you have in the quality of the data, because there's always great questions in China. And whenever you try to dig into the data more closely, you bump into that question. Just last year, yesterday, there was news that the central government was cracking down on provinces that were reporting wrong data that fit their official economic targets. So, how confident are you in those numbers? And looking at it by sector, I think the story is pretty convincing. They're slowing down the industrialization. They're moving to a more consumer-oriented economy and so on. If we looked at China, breaking it down not by sectors but by regions, would we have a completely different story? The East Coast is now developed. There's been a lot of urbanization, but the West is still very backwards. Are we just on the cusp of another growth spurt in the western part of the country that Beijing has identified as a priority for development? You mentioned that the growth in demand from India was the same as from China in terms of volumes, but the percentage growth was much stronger. That raises the question, is India becoming the new China? Is it on the verge of a spurt of growth similar to the one we've seen from China in the last 15 years? Or is there potential for India to leapfrog and skip some of the traditional stages of development associated with economic growth and go straight to more renewables, a cleaner fuel mix? There's a lot of things I would like to discuss, and a lot of nuggets in this presentation and the report. In the U.S. light title, I think a key question is, yes, it's a wobble because it bounces back, but does it bounce back in the same shape, or does it undergo some transformation? There's been a lot of press about the improvement in productivity and efficiency. Are those scalable? Are those permanent? Or are we likely to see a fallback in efficiency and productivity? It looks like from yesterday's DPR report from the EIA that the efficiency of new wells is actually stalling, has been stalling for the last few months, and maybe even declining back. So a lot of questions. And I like the piece of OPEC, about OPEC and the logic behind not cutting production in the first place and then cutting it in the second place. I think I would argue that maybe from a game theory perspective, there's even a value for OPEC in surprising, in mixing its responses, regardless of what the market conditions specifically may be. There's great benefit in mixing, 40% this and 60% that, and keeping the market guessing.
I want to just, Antoine, as a follow-up, this slide here showing we're talking about peak oil demand, and oil demand's been growing quite a bit faster, and demand projections have been being revised up rather than down, at the same time that we're talking about peak oil demand, you've been looking at the issue a lot about what the outlook is for oil demand. So I was just wondering your reaction to this, and what have we seen in the last couple of years that explain why, notwithstanding talk of a transition and alternatives to oil, we're actually seeing pretty robust growth, and do we expect that to continue?
It's a big, wide open question. I think anybody who's been in this field for some time knows that we tend to extrapolate from the recent trend. What happens in the last few years, we tend to see as the way of the future. So, a lot of us were not all of us, but many of us were very convinced a few years ago that peak oil supply was here. Now we talk about peak oil demand with the same degree of certainty. There's obviously many questions around it, and there's a lot of hype about electric vehicles and digitalization, self-driven vehicles, and so on. But cars are just about 25% of the market. The oil market, if you look at just U.S. cars, it's a lot less, of course. Even if you're bullish about EVs and you think in 15 years it's going to make really big inroads into the market, between now and 15 years later, there's a lot of new demand and new pent-up demand coming up from India and from newly industrializing countries that will not be met by technologies that will not be ready. So where are we in that race? And then there's all the other sectors aside from personal transportation, personal mobility. There's commercial mobility. There's power generation, there's industrial users, and there's petrochemicals. Usually the consensus in petrochemicals is the opposite as it is in transportation. And I think you made the point before in your outlook back in February that regardless of what kind of scenario you had, high growth or low growth, the outlook for petrochemical demand looked fairly similar. And under any scenario, it looked like demand for plastics and so on would really support strong use for oil. And I think maybe those assumptions could be questioned. And you could come up with scenarios in which you have actually a lot less oil demand from the petrochemical sector, for instance.
Can I just make a point on peak oil demand? So I've been a strong voice in peak oil demand, pushing the peak oil demand aspect, but I'm surprised...
That you think it's coming sooner than...
No, I'm surprised how literally people have taken the peak oil demand. So people have really got into saying and trying to date it. Is it going to happen in 2023 or is it going to happen in 2035? Which seems to me to miss the point, right? Nobody expects oil demand to grow rapidly. And at the point where it reaches the point of inflection and starts to decline, nobody expects it to decline rapidly. For me, the power of peak oil demand was more at a rhetorical power. And the rhetorical power was to say much of the last 20 years has been defined by peak oil supply. So it was in a world of scarcity, and the way we thought about oil, the way we thought about the operations, the behavior of the oil producers, the behavior of the people that owned oil, was defined by peak oil supply and it being scarce. For me, peak oil demand was as a rhetorical way of saying we've moved to a different world. We've moved away from an age of scarcity to an age of abundance. The oil, we will never run out of oil. And at some point, oil demand will start to decline. When it starts to decline, how quick it starts to decline, it's sort of frankly not very interesting. The point is we've moved from scarcity to abundance. And so I think some of the recent discussions of oil demand have missed the point. And they've got very sort of fussed about, is it 2023 and frankly, nobody knows. But the point is what we do know now is we're not going to run out of oil. And that's affecting people's behaviors already. It's affecting the behaviors of oil companies. It's affecting the behavior of oil producers. And that seems to me what matters about oil. It's moving from peak oil supply to peak oil demand, age of scarcity to age of abundance. And I think that's what matters rather than fussing about whether we can date it in any serious way.
Yeah, and I guess the other part of the conversation is whether the shift to slower growth or slow decline could become more disruptive to faster decline. I mean, that's part of what people are talking and asking about too. Amy, I don't know if you want to comment on that, because you spent a lot of time looking at that in the program at UC Davis.
Yeah, so we have a new terminology. We call it the 3 transportation revolutions. So that's mobility, electrification, and ride sharing. And the question is, If you think about, and Antoine can probably comment better on this than I can, if you think about the traditional way that many agencies and companies and even academics model oil demand, there's sort of this preponderance link between wealth effects, growth, global, economic growth, and then people buying cars, right? So society becomes more wealthy, more people can own a car, more they're going to use the car, and that was the sort of view that oil demand was going to go up forever with population. So I think that when we look at it, we look at sort of the breaks in that pattern. So if in cities, instead of having it be that everybody's moving to the suburbs, they're all going to get a car, and they're all going to use that car to commute into the city. You're starting to see in certain places in the world where cities are closing their urban centers to automobiles completely. You're seeing a preponderance of people in certain cities who are more inclined to not own a car and to use ride sharing. There are cities that no one's done it, I think, terribly successfully, and in fact, San Francisco might have been the place you thought would be most successful. And perhaps a recent study came out and showed that so many people are using ride sharing in San Francisco that the public transit's not doing very well. So I don't want to say that we're on this pathway and it's a given, right? But to the extent that policymakers, especially in urban settings, care, and I think there's a lot of evidence that they care, and there's a lot of evidence, not only in the OECD, but in the developing world, that citizens care about the quality of life, and there's no point buying a car, or even if you buy a car, there's no point taking your car to try to drive to work if there's so much congestion. So what that means is the whole way we project demand in the future, which is based on some interrelationship between purchasing power parity, GDP per capita, and growth, means that this car stock number that everybody has in their models is too high, because in the last couple of years we're seeing this decoupling between I'm wealthier and living more urbanly, and I'm going to buy a car. And so I think when you envision, what's the sort of city of the future going to look like, it is kind of hard to imagine this view. And we've done some studies on India, for example, in particular, where we found that in certain cities in India, there is actually a statistically significant saturation effect. In other words, the city continues to people in the city become wealthier, and they don't buy cars. There's a moment in time when the city becomes so large that people just stop buying cars. And so I think the dialogue about, how is demand going to look, and then I would kind of say it, similarly on the petrochemical side, there's a whole international movement now about plastics in the ocean. Right? So, to what extent is there going to be a greater emphasis by governments on recycling or substituting of plastics for biomaterials that can be disposed of more readily? In Europe, I think it's been very effective by ending landfill policy, right? You're not allowed, in many countries, you can't have any additions to landfill. Just to give you guys some insight on California used to export its garbage to China, believe it or not, and now the Chinese don't want to accept that waste. And so people are having to think more creatively about how to solve and tackle the waste issue. So I do think moving forward, there are a lot of uncertainties to the worldview that would say that, there's this inexorable, pace towards using oil, and it really can't be changed, or it couldn't be changed significantly.
I wanted to come back, Spencer, to the coal question to understand kind of what we're seeing right now and what it may mean for where we're moving forward. And I think when I introduced you, I sort of said you seem to get conflicting signals, and people see headlines and they infer things from the headlines, right? You see a headline that China is imposing restrictions on the number of days that coal can be produced, and people are like, look, they're moving away from coal, and in fact they're trying to prop up the price of coal to keep the mines open, and then they rolled back the policy as soon as imports went up. Different, sometimes conflicting statements, I think, coming out of government ministers in India, obviously in the UK, where they just shut down after the 200 years after the Industrial Revolution, the last coal mines, and to what extent and how important policy is to this. So in China, you talked about the structural shift, but as I just mentioned, they had a policy in place to prop up the price of coal, and then they backed off of that. We see other parts of the world where very strong support for renewables sometimes goes hand in hand with permissive policies for continued use of coal. So where is coal today, and help us understand, is coal, a dying fuel or not?
So just briefly, for those of you interested in this, if you haven't read into what happened in terms of Chinese coal policy last year, it's really fascinating. I got quite carried away with it preparing for this speech, and I ended up having about 6 or 7 pages of notes understanding what's in, and I was told I was allowed 2 paragraphs to try and summarize. But essentially what happened in China last year was they were taking steps to reduce the amounts of spare capacity they had in the domestic coal system. And they had a process essentially reducing the amount of capacity and trying to increase the levels of consolidation. And they also overlaid that by having a policy which reduced the number of days that mines could operate from 330 days to 276 days. Now, part of this, what they were trying to do was do 2 things. They were trying to reduce the degree of supply, excess supply in the market, but also trying to get prices up to a level which, for those mines which were existing, they were profitable and sustainable businesses going forward. And so there was a slight tension here. They were trying to choke off supply, but they were also trying to get prices up. The policy worked, in some sense, one could argue, perhaps too well. So you saw, I haven't got all the charts here, but they're in the presentation. The Chinese coal production fell very sharply. I think it's a 6% number, by far and away the biggest fall we've ever seen. And coal prices then shot up by about 60%. And the nature of these markets, they're global, so you saw this price spill across the whole of the world. This was too high for China, and so then they had to then back off of that policy. And so now what they've moved to is essentially a price band, which is sort of somewhere above where the prices had got to, in the point where they have very significant excess supply. So this is a price band where productive, efficient mines can survive, but below the very high levels they got to before. So it's sort of somewhere in the middle now. I think the big drivers of the falls in coal consumption over the last couple of years have been US and China. So China is just this enormous commitment to move away from coal towards cleaner fuel. So they're growing, very rapid growth in renewables, extraordinary growth in nuclear, strong growth as well in natural gas, trying to move away from coal and seeing very significant falls there. But the actual quantitatively as big, if not bigger, falls has happened here in the US. And the story here in the US is my reading and understanding of it is less to do with regulation and policy, and it's to do with the economics of shale gas. As shale gas has come forward and grown over the last few years, the price of gas, natural gas in the US has fallen, and as a result of which, it has crowded out coal in the power sector. So in 2015, so 2 years ago, gas overtook coal as the most dominant form of fuel within the US power system for the first time ever on history on record. And that remained the case last year. But the big driver of that was prices. The other interesting question in the UK, there's some nice charts in there where I go back to the 1800s and just show that the UK has gone through this entire cycle with consumption levels now back to where they were in the 1800s at the time of the Industrial Revolution. What the UK did was UK is a member of the European Carbon Trading Scheme, where the prices for carbon there is about $5 a tonne. And what the UK said was, we're going to put in a floor, a carbon price floor. So if prices get below this floor, which is set around £20 a tonne, we're just going to keep them there. So we're not going to let them grow any lower. And that carbon price floor really worked. And as a result of which, you saw essentially almost the entire crowding out of coal within the UK power sector and replaced by natural gas and renewables. And the policy message here, and it's a really important policy message here, is prices really work. look what's happened into the US power system as the price of gas has fallen relative to coal. Look at the UK when you introduce a relatively minor carbon price, what's happened to coal relative to gas and the savings in carbon emissions. And policymakers are often very nervous about using prices and they prefer regulation. As economists, we prefer prices because we know if you allow prices, you allow markets and businesses to find the equilibrium in the most efficient way. If you rely on regulation, you rely on politicians to pick winners and losers, which typically is not the best recipe for success. People are nervous about prices, but I would say, well, look at the last couple of years. Look at the data points. When prices have moved, it's had a major impact on the fuel mix and had really significant improvements in carbon emissions.
Yeah, and some of those charts too, just to promote our work for a minute, some of you may have seen a few weeks ago the study we put out from the Energy Center, Can Coal Make a Comeback, which tried to disaggregate what the factors were that drove the decline of U.S. coal, shale gas being the most prominent, but also weaker than expected electricity demand and falling renewable costs, and something that I don't think has gotten as much attention, which we in our modeling found more than half the decline in U.S. coal firm revenue that has led to all of these bankruptcies came from the collapse of the Asian coal market, the Chinese coal market, because it led to such a steep drop in the price of metallurgical coal, which even though it was a small share of U.S. production, was a disproportionate share of U.S. coal firm revenue because metallurgical coal used for steel and cement as opposed to steam coal for power is so much more valuable. So encourage people to take a look at that. I want to open it up in a few minutes to questions, but there's a couple of things we haven't talked about yet, and I want to give you a chance to comment on where we are today, where we might be headed. First, on natural gas. What's happening with gas demand today and production, and do we see the gas market growing or getting squeezed by policy? I mentioned a minute ago, strong support for renewables, a low price on carbon sometimes props up coal demand. Have we missed a golden age of gas that some people thought 5 years ago we might see? And then talk a little bit about sort of the rise in LNG trade and what's going to happen to the global gas market moving forward.
So in terms of the data for 2016, for natural gas, it was a relatively muted year. So demand grew by about 1.5%, which if you compare that to oil and growth rates of oil in the past, that's a pretty strong growth rate. It was pretty similar to oil this year. But compared to the average for gas in the past, that's a relatively muted growth rate. Gas production was essentially flat. So extraordinarily weak growth in gas production. And that's part of that sort of excess supply story I was telling you about. And what was interesting and what was a big driver of that weak gas production in 2016 was the US, where US gas production fell in outright terms for the first time since the shale revolution started. And the story there was both the falling gas prices causing dry gas rigs to fall off, but also the fall in oil prices, meaning the growth of associated gas also slowed very sharply. And those two things came together. The other thing which happened last year was, if you like, we had the first year of the growth spurt we expect to see in LNG. So last year, that growth spurt was very much concentrated in Australia, enormous growth in Australian gas production, and then that gas production feeding through directly into liquefied natural gas. And we expect that growth spurt to continue in liquefied natural gas over the next 3 or 4 years. This is not an economic prediction. This is more a sort of logical accounting exercise, just looking at all the projects which we know are nearing completion, and so you can just add them up and see them coming through. So we expect something about like a further 30% increase in LNG supplies over the next 3 or 4 years. And this will fundamentally change the nature of global gas markets. And it fundamentally changes it for the basic reason is that LNG is mobile. So if you have a pipeline, it can only go to one country. You can't pick the pipeline up if somebody else is offering you a better price. And so you end up with segmented markets. LNG is mobile. And so, BP has an app. You go on the trading floor, has an app, and it looks like a radar screen, and it tells me where every single LNG vessel is at the moment, what gas it's carrying, where it's going. And
how do they look coming out of Qatar?
Well, they're wobbling at the moment. And where you get a higher price if you said stop, turn around and go somewhere else. And so as a result of which, this starts to integrate the global, so we're developing towards a globally integrated gas market, just like we have an oil market. That market is also changing in structure. So rather than very long-term contracts, we're seeing a move towards shorter contracts, very sharp movements. Jason was looking at some of the charts in the for the presentations. Smaller contracts, shorter contracts, and more generally far more gas not contracted at all and just freely traded. So we're going to move into a sort of spot, deeper and more competitive spot market. And so for many years, the gas market has behaved very differently to the oil market. And that was essentially because it was segmented and driven by pipelines which require long-term contracts, very little flexibility, very little competition. LNG changes everything. And so if you see the gas market having features which look different to the oil market, your instinct should be why and how long will that last? Because we're moving, the market for gas is moving towards like the market for oil. And I think it changes sort of everything for gas.
And by the fastest growing form of energy is renewable energy, and many people who do long-term outlooks, whether it's IEA or EIA or yours or others, have underestimated how much renewables can grow and how quickly costs can fall. Is that something that you expect to continue? I mean, especially with the withdrawal from Paris, part of what you heard from some quarters was this transition is unstoppable, and it's not about policy. It's happening anyway, just because of market forces. Talk a little bit about what you see happening in renewables and where it's going to go, just driven by how quickly market forces are changing.
So renewable energy is continuing to grow very rapidly. It grew slightly less rapidly last year than previous years, and that was a sort of odd soft spot, and it was just an interesting data observation. Renewable energy in Europe did not grow at all last year. This has been the sort of the vanguard of growth, and it didn't grow because load factors for wind and sun in Europe in 2016 fell quite sharply relative to 2015, and as a result of which you had no growth. And so it was just a reminder for all of us that not just on a day-to-day basis, but on a year-to-year basis, variability in weather can have quite significant impacts. So I think it's true to say that Denmark, just because of lower wind speeds, their reduction in wind power was equivalent to 5% of their total power generation. That variation from 2015 to 2016. So it's a big deal. But the general point here is wind and solar continue to decline. The costs continue to decline very sharply. And so we're seeing strong growth. And BP's view is, or my own view is, we'll continue to see that happening, and we're likely to see that happening going forward. Just the caveat here is, though, that energy transitions in history have been measured in decades, and multiple decades, not years. So the time it took for oil to go from 1% of world energy to 10% of world energy was about 45 years. For gas to go to 1% to 10%, it took over 50 years. Nuclear energy still hasn't got there. We're about 6 or 7 years in for renewable energy from its starting point of 1%. Our best guess is it gets to 10% by 2035. So that will be after about 30 years. So this will be quicker than any fuel ever seen in history. 10% by 2035. Suppose we're wrong. Suppose it goes far, far, far more quickly and gets to 15%. What that's telling you is you still got 85% of your energy somewhere else in 20 years' time. And so it's just the message from history is, I think this is happening. It could happen more quickly than any fuel ever seen in history, but it's still only likely to provide a relatively small share of the energy the world needs to power itself in 20 or 30 years' time.
Amy, you're in the heart of the renewable revolution in California. Do you agree with that?
I do and I don't. I mean, it's very hard to change the energy system, but then I do think we've seen some sort of unpredictable factors. And so, not to be so California focused, but I'd like to tell the story about California, and then I'll talk a little bit about its implications, say, for natural gas, a fuel that everybody sees as a growth fuel. So I guess it was last year, maybe it's a little over a year now, there was an accident in Southern California at a major natural gas storage underground storage unit doesn't give you a broad enough view. I mean, it's a giant underground structure that held natural gas in Southern California. And the accident was so bad that it took them 3 or 4 months to even figure out how they could stop the methane from flowing. And people who lived in that area became very sick. Then they were on TV crying. And this went on for about 12 months. Then they told people they could go back to their homes. People went back to their homes and they were still sick, having lived 12 months in a hotel. So how did that affect what happened in California? How that affected what happened in California is the state had already had some very ambitious, seemed like crazy ambitious target for renewable energy and battery storage. There are many companies that are emerging companies in California that are making a big business out of battery storage. So they all went to lobby Sacramento and Southern California to get fast-tracked. And about 100 megawatts of solar and battery storage was installed in about a 3 or 4 month period, which was, almost, half or 2/3 of the target that was originally set for 2020. And it happened like this. So the real question is, how sustainable is these, traditional fuels going to be? And how fast is the public going to move? And I have this story I like to tell. It's a little bit of an analogy. Sitting in California or seeing how people feel about air quality in China and other places. So we're all walking around with this computer in our pocket, right? And it costs 1,000 times more than a landline in your home. And my phone bill, because I can tell you my millennial children are still on my bill, even though they're adults and make probably more than I do. Everybody is paying a lot of money for their monthly bill, more than they would pay if they just went back to their landline. But no one's going back to their landline because the cost doesn't matter. It's a superior technology. You're getting so much more utility, you're willing to pay more, right? So the question is, at some point, whether it's because of cybersecurity or because of accidents or because of sustainability or because of convenience, is there going to be a superior technology that will be enabled by these batteries, and therefore are people going to move to that because it's a superior technology? Yeah. And what's the pace of that? Because even the cell phones, took a long time, right? So that, I think, is the conceptual way that we need to think about it. And when you do this sort of historical, view of, the march on energy, we started out with wood and, we have something that goes back centuries. Is that really relevant? When you think about the pace of technological change we're seeing where, we're all for fear that we're going to lose our jobs to some kind of artificial intelligence, right? Even Antoine and I who do, energy modeling, like maybe we're going to teach something to do machine learning with this data, and they're not going to need us to give our intuition about, what we think is going to happen in the market. So,
sorry, the case, I think.
Yeah, right. So the question is, what's going to happen in terms of social and cultural acceptance of different technologies, and what is the potential for superiority, of batteries, for example.
And of course, the other way to think about it is not only waiting for the technology to become superior from a user standpoint, but that there are social costs from using one versus another, and it's the job of policymakers to internalize those social costs. But we somehow seem to not be talking about that much anymore these days.
So I have a question for Spencer on
and then I
natural
want to
gas.
open it up and come to the audience.
If you don't mind.
Yeah.
So I have this sort of interesting question for you, because the way you describe sort of this sort of flexible LNG market, which I agree is going to be much more flexible. But there's just such an excess of natural gas supply globally, in regional markets and globally. And you mentioned Australia as a case in point. We have the very, very, very large resources here in the United States that if California and other places go to batteries is going to have no home, right? So the question is, in this competition for markets, you talk about pipeline versus LNG. Is there some structural reason why someone who's already sunk all that capital into LNG, they're going to sail those ships one way or the other? Are they going to be the ones that do that, and therefore the pipeline gas, because it's cheaper, is going to shut in? Or is it the other way around?
And maybe while
Who's
you give
going to shut in?
a brief answer to that question, I'll ask anyone who has questions to come and stand at the microphone here so folks watching online can hear you, and then we'll take a few questions from the audience.
So I think I think the sort of glut of LNG story, which I recognise, I think is a short-run story rather than a long-run story. I mean, in the long run, markets will equilibrate. In the short run, we do have this sort of, we're likely to see this glut of LNG. I think ultimately this will come down to will LNG be able to compete, particularly against coal, within Europe. So the marginal source of supply will be US LNG. The marginal market, if you sort of cut through everything, will be Europe. I spoke to many US LNG exporters, I'm sure you have, who said over the next few years, where we're only trying to cover our operating costs, we'll be able to land US LNG in Europe at $4. With a carbon price of five euros, that is not enough to displace. That's still too high to displace coal. And so, at the moment, that type of analysis would say this US LNG would just be shut in because you won't even be able to cover your operating costs. This goes back to my power of prices. You wouldn't have to do much in Europe to allow $4 landed LNG to be competitive. But I think just in terms of the nature of coal as the marginal sort of source of energy in the European power system, you could get that US LNG shut in for a period of time until the market equilibrates.
So I don't see questions here, so I'll just keep going.
Oh, no, here we are, yeah.
Okay.
Hi.
If you could briefly identify yourself.
Yes, my name is Surendra. I'm an ex-banker, now just an energy investor. You know, in the last 2 years, we've seen tremendous number of shale producers really either go bankrupt, reposition their balance sheet, or acquired. Can you share with us how does OPEC look at its total cost as compared to somebody as a shale producer who looks at my cash cost is less than $15 a barrel. I will continue to produce as long as it makes a contribution towards my fixed cost or my expenditures, as compared to an OPEC producer. When you sit in their room versus when you sit into a shale producer, give us a sense of what are the differences.
So I think this relates to my Weeble point a little bit. So when you think about, so the economics here is in the near term, you'll carry on producing if you can cover your operating costs and do a little bit of your fixed cost. What's special about US tight oil? It has relatively small proportion of its costs are fixed because it's like manufacturing. And so even though its all-in costs are relatively low, quite a high proportion of those are variable. That's why it comes off more quickly, because its variable costs are relatively high. Because the variable cost of producing oil, if I've got a platform in the middle of the sea, I've done all the drilling and the oil's flowing, the operating cost then of a barrel of oil is very, very low. And so it never makes sense to me to turn off that barrel. That's why in the short run, technically why tight oil come off. But the all-in costs of tight oil are relatively competitive. And so once the market adjustment works through, which is there's less investment in high-cost oil, this will come bouncing back again. So I think in some sense, in the near term, the operating costs of shale are quite high, which is why it's come off far more quickly than anything else. In terms of just the numbers, it's got the biggest swing. But that tells you something about near-term dynamics. It doesn't tell you something about long-term resilience, which is sort of hence my my Weeble analogy.
So is the takeaway from this quote you put up here and the way you explained it that leaving the cyclical factors aside, there are now structural changes that have taken place in the oil market that OPEC either is unwilling or unable to deal with? That means we're in a lower for longer environment, and that has important geopolitical and economic impacts on countries that are dependent on oil revenue.
So I think it's what's the economic implications of a new source of intramarginal supply? Not that the low-cost producer, OPEC, should reduce its supply. That would make no sense at all. It's the high-cost oil has to be crowded out. That high-cost oil, remember, has a very low operating cost. And so what you need is that to happen over time with natural decline rates and less investment. So it takes a long time. So one of the messages we know from the oil market is supply shocks take a lot longer to adjust to than demand shocks, because demand shocks, you come off, you have a recession, a couple of years comes back on. This is why Bob Dudley, right from the word go, said this is a lower for longer, because this was a supply shock. We know from the 80s supply takes a long time to absorb. It doesn't mean it's lower forever. It just means it's lower for longer.
And you share the view that we're kind of setting ourselves up for an underinvestment cycle because of these steep cutbacks and CapEx? And
I think we're setting ourselves up for reducing investment, but remember, some of that reduced investment is the market mechanism by which higher cost oil starts to lose its share. So some of that reduced investment in higher cost oil is exactly the equilibrium mechanism you need to see. Now, some of it may well overshoot because of the nature of the oil market and things, but some of that is the adjustment mechanism you need to see. If you need to make space for this intramarginal barrel in the middle, and OPEC are maintaining its market share, you need less over here. And so what we have seen is we're seeing those investment reductions concentrated in higher cost oil, which is exactly how you expect the market mechanism to work.
But let me give an alternative view on this, okay? So these guys are, I think Ryan Lance of ConocoPhillips said it best, these guys are in the first inning of a 9-inning game, right? And in this first inning, and Spencer showed the statistics, there were a lot of what Goldman Sachs called tourists in the industry. And they were drilling everywhere in the United States, even places where it didn't make any sense, right? But now you have a lot of infrastructure that's in place where people can go back with better technology because they're improving technology, they're using real science, people are using everything from bio-DNA to, advanced data technologies. And what you're going to find is that people who drilled in these outlying areas that were not as commercial or who over-levered are getting wiped out. But the people who are left, who know what they're doing, they're going to keep their infrastructure filled, and their OPEX is incredibly low. And if they can go back to some place they drilled 5 years ago and go back in with better technology using the same exact infrastructure, their variable cost is pretty low, right? So I think that OPEC is going to have this huge challenge, not because...
So that's what you're saying supports the Weeble idea, no?
Yeah.
But more fundamentally for OPEC, can these countries really survive the kinds of numbers that are going to come from this production? And, I'm not of the view. There's a view that this is a North American phenomenon, which, of course, if it starts to be a Mexican phenomenon, I mean, people didn't think it was going to be a Canadian phenomenon at all. But really what's happened here is not just shale. It's that fundamentally a group of companies, and not the companies we're used to thinking of to innovate, have come up with a way to take oil and gas molecules out of source rock. And that means that you could do, if you put your effort in, you could take it out of any source rock. So the idea, you're going to have maybe some aberrations, you're going to have geopolitical events, you're going to have some, capital that gets inefficiently deployed that could cause the price of oil to go back up for some period of time. I'm not saying that couldn't happen, right? When we're seeing the events today among players in the GCC, you can see that unexpected black swan things can happen. But fundamentally, as the technology improves and as I can produce oil and gas from source rock pretty much anywhere.
So I want to see if there are other
the
questions here.
point is, we're never going to go back to the depletion story.
But I just want to, Antoine, see if you have any comments on this, because you've been thinking a lot about what's new and different about shale and what it means for the market.
Well, I think innovation is nothing new in the oil industry. There's always been innovation. That's precisely the reason why the hoteling model of oil pricing has repeatedly been proven wrong, because it's not a finite resource. It's a resource constantly expanded and renewed by innovation. So shale doesn't have a monopoly on innovation. It's just a new kind of resource that innovation has unlocked. My question for Spencer, maybe to build up on your question, would be, the cast of characters in the shale players is changing. And initially, as you said, Amy, was not companies we were used to we didn't know, newcomers and very nimble, not very deep-pocketed and so on. But with the consolidation that we've seen as a result of bankruptcies and so on, the majors, and BP was not a big force in the shale industry to begin with, but now the majors are making inroads into the shale plays, and some of the independent shale operators are getting larger. So are we going to see, is this going to have an impact on the trajectory of shale production and the incentives of shale producers looking forward?
Do you want to go? Do you want me to answer that, or do you want to get questions?
Are there other? There's a question over here. Let's take one question.
He's in a hurry.
A hurry?
Okay.
No, in a hurry. I think
You just need better need the mic, otherwise people won't hear you online. Sorry.
I think one of the problems is that we're actually talking about three different kinds of players. Most of OPEC's oil is state companies or companies very closely related to the state. And a country like Saudi needs oil revenue regardless of what the conditions are. So they're going to produce come hell or high water, and it's just a question of how much they're going to produce. If we look at shale in the United States, as the gentleman said, we started out with a situation where we had a lot of marginally capitalized companies, and being the proud owner of several that are now in bankruptcy, I can tell you that they didn't make it. But as an investor in energy, I think any investor in shale has to wonder what they're doing. And the reason I say that is stocks go up on dreams, as my father said, and down on reality. And if shale companies don't continue to try and expand their production, if their annual increase doesn't go up, they're going to be pulverized in the market. And yet, if they keep spending, they're going to go beyond what they can afford to do. So the question becomes, at some point, investors are going to say, why should I invest in this stuff? And you have a third category of company, which are companies like your own company, BP, or Exxon, which are large international companies, and they seem to be able to hide losses so that they can continue to do this for a longer period of time. And it's harder to predict what's going to happen to them because they have much better staying power. But I think in order to understand what's going on, you have to consider who the producers are and how they're going to react, because unfortunately, players don't all react the same, so that the conventional economics don't always help you predict what's happening. And I mean, my question is always, why should we be supporting these small shale producers? Because I think they're all going to be beaten up or eaten up at one point or another, and not necessarily on terms that are good for the original investors.
Relating to your question and Antoine's question, I think one difference about tight oil, in terms of just thinking about sort of the economics of it, the economics of tight oil are quite different. So the barriers to entry are an awful lot lower. You don't need billions of billions, you need hundreds of millions to go in, or perhaps even less than that. And also the nature of the play, of any individual play, is a lot less risky. So you pretty much know what oil you're going to get out of the ground. You sell that oil forward, and you get the vast majority of your break-even within a couple of years. This is very different to do exploratory oil in billions of dollars with very long payback periods. So in a world where almost anybody can do it, you have a payback of 2 years, you sell it forward so the price risk is relatively low, why should you earn double-digit returns in that type of business? This is a very different business proposition to, and so this relates a little bit to Antoine's question. So for an IOC, it's a sort of slightly, I quite like playing in these fields where only I can play. I need a big barriers to entry, and I can use my balance sheet. That's a sort of comparative advantage I have, and as a result of which I access things where we would expect to see is a risk-return trade-off, where this is a different proposition. And it's interesting how, it'd be interesting as we go forward, if we do see significant consolidation, how big IOCs can have a foot in one camp, in two camps, with very different risk characteristics and very different expected payoffs. And I don't know quite how that will work. I mean, I think it's an interesting question, but it feels to me intrinsically a different type of corporate finance play in one than the other.
We only have 2 minutes left, so I need to wrap up. I'm sorry, but I just wanted to give you 90 seconds to comment on something we haven't brought up yet, which is nuclear. We're shutting down some nuclear plants in the U.S. Just tell us where nuclear is around the world and what the outlook is.
So nuclear, there's two things going on, and they're moving in very different directions. So one is conventional markets, America, some of the conventional markets in Europe. Both the economics and politics of nuclear are both very poor, and so as reactors are coming up for decommissioning, they're not being replaced, and so we're seeing a gradual decline in nuclear capacity in those conventional markets. On the other hand, we're seeing an extraordinary growth of nuclear energy in China. China last year brought on 5 new reactors. It has another 20 under construction. Its nuclear program is equivalent to bringing on a new nuclear reactor every 3 months for the next 20 years. Astonishing. Why? Because as coal declines, it needs to have that growth in nuclear alongside equally rapid growth in renewables and in natural gas to fill the hole left by coal. And so what you're seeing here, in some sense, the growth rate of nuclear is around normal levels, and we expect it to sort of its share to remain pretty stable going forward in primary energy. But that reflects two very big sort of forces going in opposite directions. And we all know from economics and accountancy, if you're taking two very large numbers away from each other, you can get it wrong quite easily. So if one of those things is slightly different to the other one, you could see sort of a different pattern. And I think the interesting issue here is nuclear never got to that sort of 10% stage because its learning curve flattened out and, if anything, started going to reverse. You haven't had lowering costs. If China is successful in bringing on new nuclear reactors as rapidly as they expect to do over the next 10, 15 years, it may well be that they will start to get better and better and better at it. That learning curve will come down. And so, therefore, the economics of nuclear in other countries may start to get better. Now, you may say that the politics of nuclear in some of the OECD means that even if the economics get better, you may not get much traction. But in parts of Africa, in parts of the Middle East, if we start seeing nuclear economics in nuclear doing, then you may see that growing more quickly than many people expect.
Thanks. Well, I want to let you get out on time. I know lots of people want to visit with you and see you while you're in the U.S. sharing the output of the statistical review. We appreciate your joining us again at Columbia University at the Center on Global Energy Policy to share the insights. As I said in the beginning, it seems like every year we have you. Things have changed at a more rapid pace than one expected, and there's more to talk about and more uncertainty. So hopefully you'll come back again, both for the energy outlook and also for the statistical review in the future. So thanks to all of you for joining us again. This event and all of them are available online. The full video recording will be up in a few days, and on our podcast series on iTunes, along with Columbia Energy Exchange. Sort of think of it like a virtual event where we bring on guests, but we do it virtually and you can all listen. We talked about what's happening in Qatar with Bernie Hakel at Princeton and Halima Croft just 2 days ago. That's released every Monday. And then we will be back at the Columbia Club on July 13th to focus on the gas market and talk about the 5-year outlook for the gas market with Fatih Birol, the Executive Director of the IEA, and they'll be presenting their new report on the outlook for natural gas. Thanks, Antoine, thanks, Amy, and thanks, Spencer Dale, for joining us. And please join me in giving a hand to our panelists.